Hey guys, welcome to this week's Money and Investing Show. This week we are tackling the dichotomy, if you will, between economic statistics and economic facts. Are they the same thing or are they not? You're going to find this quite interesting to look at both the positive and the negative columns and get a gauge where we as professional investors see these markets going. I know you're going to enjoy the show and I'll see you in there shortly. Hey guys, welcome along to this week's Money and Investing Show with me, your host Andrew Baxter, and as always, my offsider, Mr. Mitchell Laurential.
Mr. Faithful Offsider, Andrew Baxter, thank you for having me on the show. And the economist that you are, I really need to get your take on a few things today. If you wouldn't mind, you'll probably get rolled up. We'll probably have our listeners confused. Irrational economics, the topic for today. The disconnect between what's going on versus the numbers.
Well, it's a very good subject, isn't it? Because, if you look at the economic statistics versus the economic reality, they seem to paint very much conflicting opinions and perceptions of what's going on. So let's break it down, because I think to be able to invest, you've got to have confidence. And the only way to have confidence is to have a high level of certainty. And when you've got this morass of statistics saying one thing and anecdotal evidence telling you something else, there is something of a conflict in there. So this will be an interesting one, that's for sure.
Absolutely. Well, it's really quite peculiar because there's a couple of positives and negatives that we can touch on. However, they're kind of at both ends of the spectrum. And I guess there's a lot of confusion thus far. Why is that and what's going on?
Look, it is a challenging time for investors to really confidently plant the flag, because what we're seeing in terms of statistics are painting a very strong picture in one way. We can talk about consumer confidence, we can talk about interest rates being at record lows, we can talk about inflation being at record lows, and yet if we look at anecdotally, we've got high levels of unemployment. In reality, inflation is far higher than the advertised figure, and you've got effectively a direct unemployment rate, a real unemployment rate of about 13%, and arguing that against record and strong consumer confidence, it's a very unusual set of circumstances, that's for sure.
How does that actually happen? If people aren't employed, they shouldn't have any money. So why are they feeling confident enough where they can go and spend?
Well, that might be where we conclude things. Let's dive in a little bit on this. So, if we break this down into two sort of columns, positives, negatives, and try and explain what the difference is. And on the negative side, we're looking at unemployment, real unemployment, and I guess we've got to clarify what that term is. Yes, I'm an economist. Most people listening to this won't be, and so we're going to keep this in very simple terms, not to be condescending, but to open the door to what this really is. Real unemployment includes things like underemployment. So right now in Australia, if you have paid employment and you work 1 hour a week or 1 hour a month, you are deemed as being employed. Yet 1 hour a week or 1 hour a month is such a long way away from being actually employed. Employed should be full-time or part-time work, not an hour every now and then in exchange for money. So you can easily get tied up on the definitions of what a job actually is. Common sense would tell you, a part-time job of 20 hours a week or a full-time job of 40 hours a week plus, that's
employed,
work.
Sure.
An hour or two a week, come on, we're kidding here.
So what's the real rate of unemployment in that case?
Around about 13.5%.
Wow,
yeah,
it's a lot.
I heard an interview this morning with, I think it was the CEO of ACOS, and she was talking about effectively for every single job applicant, job availability, there are 12 applicants right now.
That's crazy.
So 12 people going for every single job that's out there in the marketplace. It doesn't feel like that. And we've been interviewing, we've seen what the quality of the job market looks like. There's some good talent out there. There's an awful lot of dross as well.
There is.
And also, legislation that's been brought in to attract people back into the workforce, government subsidy to do that. It's been very orientated around young people, to get young people in the workforce. And I'm a huge advocate for that. But by bringing in financial incentives to hire young people over older people, effectively what you've got is a government-sanctioned discrimination based on age. You can't even ask someone's age in an interview. It's not a legal question to ask under Fair Work law how old somebody is in an interview. Yet now, if they're under a certain age, you're going to get a subsidy for employing them versus someone that's older. And it's an extraordinary move. Now, I understand why it's been done, get the young people in the workforce, but it's at the expense of older employees. It's not a level playing field, which is, again, probably subject that we could go off-piste on and discuss ad nauseum. But the reality is 12 applicants for every job that's out there, and yet you've got on the other side of the equation such booming consumer confidence. So there's a disconnect that's there in the first instance, and that's just looking at one negative, which is unemployment.
Certainly, it's definitely quite weird, that's for sure. And to park that now to the side and say transition more into the employer's point of view, there's a lot of business uncertainty. When you can't even ask someone's age to see if you qualify for a subsidy, it makes things awfully confusing. What's your perspective on that?
But business uncertainty, any business is orientated about, or any successful business, let's put it that
Sure.
way. It's the reason why most businesses fail, because they're not forward looking. When you're driving your car, you want to look through the windscreen at what's coming towards you. And you've got to be looking further down the road than immediately in front of the bonnet. And running a business is very much the same. You can't be focused on day to day, week to week. You've got to be looking at several months and probably a year in reality. Going out past a year in the current economy is pretty tricky to do. But you've got to have some sort of plan in play that you can at least pivot from. Yet when you're dealing with the set of economic conditions that we have right now in the COVID and post-COVID environment, with elections around the world and state-based elections here in Australia, border closures, borders opening, borders closing, and all of those sorts of things, it becomes very, very difficult to be able to plant the flag and say, this is our business plan for the next 6 to 12 months with any level of confidence. Now, you may have a very nimble business that can pivot quickly and twist and turn, but if you're running a business of size, you've got to have a plan that's 6, 12 months down the track, albeit with the ability to pivot in the short term. Very, very hard to do that with the array of information that you have available to you, and also with the way that the economy is positioned right now. So there's an enormous uncertainty, which is a huge negative for business, huge negative.
And I think we've seen that reflected in the stock market, because if you think during this pandemic, all the rage, tech stocks, Zoom, Amazon, Google going bananas, their share prices going through the roof. All of a sudden, Pfizer comes out with their 90% effective drug, and all of a sudden, our economically sensitive stocks are back in business again because we're opening up. Things can change awfully quickly.
Yeah.
How do we adapt to that?
It's hard, but I mean, that's looking at a global perspective. Let's make it something really simple. Let's say you need to move premises and you're about to sign a new lease and you're looking to expand your business. Do you go for bigger premises or not? Because how certain are you that you're going to need that 20% or 30% more floor space? And these are the nitty-gritty decisions at the small and medium-sized business level that you have to contend with. You're going to be on the hook for a 3, 5, 7, 10-year lease on space, but how many people are you going to require in a year? It's pretty hard. You need the wisdom of Solomon to work that out. And that's part of the joys of being a business owner. Anyone that's self-employed knows the only reason you want to become self-employed is so you can work more than 40 hours a week, not less than it.
Sure.
And so these are the challenges that face business owners. That's just one small thing. Add to that, as you said, the Pfizer story that there's a 90% cure rate on this. If you're in tourism and hospitality, does that mean you're back to the races and everything's open? But then you've got a state premier that says, no, we're not going to let you come anyway, even though there's this going on. It's incredibly difficult to traverse those waters, and I think it's going to account for a lot of, and I so sincerely hope that I'm wrong on this, and that is that the amount of mental illness and psychological damage done to people in this uncertain environment, particularly for small business owners that are trying to do their best to keep the show on the road, to be able to employ their staff, whether that's through the support of JobKeeper or whether it's through other means, just trying to keep the show on the road and moving forward in this massive uncertainty where, look, if you're a business owner and you make some bad decisions and you're out of business, well, that's on you, and it's a big boys game, that's the nature of it.
Sure.
But if you're out of business because someone's just decided no tourists,
it's tough.
It's pretty tough. It's pretty tough, particularly if it's a unilateral state decision as opposed to something that's for a greater good. So that uncertainty is really what I'm driving at, and we're not even looking at the big macro outlook out there in the really, really big world. This is just the small stuff that trips businesses up. So again, that's a huge negative, that negative business uncertainty, that lack of security as to what's going on.
Sure. And what about, let's say, interest rates and inflation? Because you could argue both sides on those. Inflation, I think you mentioned 0.7%. Is at a healthy rate, that's quite low, and then interest rates almost at zero. Great for the borrower. If you've got cash at the bank, different story.
Right. So let's take inflation. We saw inflation actually go negative in the last quarter, and it's just bounced back. So we're looking at an annualized 0.7%. But in reality, and I'd throw this challenge open to any of our listeners right now, how does your cost of living look today versus last year?
Exactly the same.
Or more.
Or more.
Like if you take, for example, filling up your car with fuel, and that may not be something that goes into the inflation calculation, but in most instances, certainly in where we are here in Southeast Queensland, $1.35, $1.40 a litre for fuel is still the norm, even though oil prices are only $35, $40 a barrel. So that drop in commodity prices hasn't brought fuel prices down, so the cost of running your car is still there. If you're someone that's needing, and if we talk very specifically about here on the Gold Coast for a moment, the property market, we're told 1 in 7 properties are sitting vacant right now. okay, and tenants are on a holiday from not having to pay rent. Yeah, and I just had lunch with someone today that was talking about their property portfolio that they're renting, and literally there is no stock to rent. Rents are through the roof. Again, that's not something that's necessarily going to work its way through into the inflation figure, but rents are generally pretty high in this locale, as they are in a number of other places around Australia.
Sure.
Maybe not in inner city apartments, it's a bit weaker, but certainly that sort of thing. So that real cost of living for people, if you're going to go to the grocery store, it's not cheaper than it was last year, it's going to be more expensive. By and large, inflation is way beyond 0.7% a year.
What's your prediction of what it actually is? Sorry to throw a curveball at you.
I think you're probably looking at 3.5% to 4% if you were to include within the basket the stuff that's not in the basket.
Sure.
And anecdotally, you can look at different things, and I mean, everyone's got a different barometer. If you're a smoker, you probably look at a packet of smokes. If you look at a slab of beer, these things only continue to go up in price. Okay, and there's a fair bit of tax in there as well, but they only go up in price. So why isn't that reflected through inflation? So on the headline, inflation looks relatively low. You think, how good's that? We've got interest rates at 0.1, being the
basically zero,
being effectively zero. So the RBA have cut rates. To what end? I don't know, because effectively the cut from 0.25 to where they are now is so immaterial. It makes like $2 a week difference on a $100,000 loan, assuming it's been passed on by the bank. That it really has no material impact. What it does is make it cheaper for people to borrow. But if you're a business borrower, if you take NAB, for example, which as far as the big four are concerned is the bank that focuses on business banking more than anybody,
Sure.
more business banking than anyone. As a business borrower, are you going to be more inclined to borrow at 0.1 versus 0.25 when you've got such a murky outlook? Probably not.
Probably
So
not.
It's not doing enough to stimulate that. What it may well do is continue to prop up and push the property market, which is enjoying that bulletproof run, even though we've got no overseas buyers and we've got unemployment effectively at 13%. We've still got a property market that's pushing higher.
That's what I want to chat about next. This property market, I mean, talking anecdotally, Southeast Queensland is going bananas.
It's not just Southeast Queensland. I mean, it's almost a
Sure.
universal thing.
We just had a friend that sold his property for, quite an exuberant price, way beyond the scope of what you'd think. Is that because purely on rates, or is it just because people want to live in houses?
Look, there's a combination of factors at play there, and certainly the cost of borrowing is next to nothing. I mean, money is effectively
Almost free.
It's so cheap to borrow right now, and this is a very dangerous trap where you're encouraging people into the honeypot, borrow, it's cheap, and all the rest of it. And maybe and we've discussed this in previous podcasts. Borrow as much as you can. It's certainly cheap. The challenge is when rates start to move up, whether that's in 2, 3, 4, 5 years' time, all of a sudden that loan becomes very, very heavy to start to pay back if you've overgeared. And there's talk of the banks peeling back their responsible lending legislation to make it easier for people to borrow to stimulate the economy. But are we just pushing our economy ahead on an already overpriced property market? And that would be a very, very dangerous thing to do. It's very fragile, and that's certainly been one of the net impacts of those lower rates. So, inflation is definitely higher than what it is. Interest rates are certainly very, very low, and there's no room for the RBA to move. And that last cut, I think it was already priced in the market. If it hadn't happened, I think we'd have seen a weaker market. But the reality is, what are you hoping to achieve by cutting rates even further? Because the actual real difference, you're talking $2 a week on $100,000 for every $100,000. It's so insignificant. It's not going to be a major factor. It's almost just a headline for the sake of it. We've got unemployment where you've got 12 applicants for every job, 13.3% real unemployment. These are all really big negatives. Now I hate negativities. Let's move across
Let's go to
the positive
positive.
side.
All right.
What we're seeing is record consumer confidence and record consumer spending, and stocks like Harvey's, Kogan, Temple & Webster, all of these online businesses have been making an absolute killing through the COVID crisis because people have been more time at home, improving their home and spending money like it's gone out of fashion. And even if you're borrowing to do that, it doesn't matter because your borrowing costs are next to nothing. So what you've got is incredibly strong consumer activity, which is a big positive. You want to see that. You want to see yourself try and spend your way out of recession. And it's not just spending, which is also interesting to see. We're also seeing the amount of credit card debt's actually dropped by about 25% this year.
Which is great.
It's a big positive. I like to see that. I hate credit card debt. I think it's a terrible, insidious thing. So seeing people get that paid down is good news. The question is, okay, so we've talked about the consumer spending. We've got a red hot property market again, and look, a strong property market is always good. It's better to have a strong property market than a weak one in terms of your overall economic strength. But what is pushing this along, and where is the pause button on this? 1 in 7 properties empty. Okay, you've got the ability of your tenant to fall on hardship and not pay rent for 6 months. Yields have dropped through the floor. You've got a lot of businesses gone to auto, commercial properties opened up, yet we're seeing this property price just continue to
It's
bump
totally
up.
irrational. It makes absolutely no sense.
Is this the final blow off?
I wonder, where's that psychological level where it stops? And we can almost say the same about the stock market. That's been off to the races. Post-election, Joe Biden getting in is great, amongst a few other things, vaccine news. I mean, we've had great results this week on some of our long positions. What's your take?
Absolutely, money has to go somewhere. Holding cash is not an investment asset. It's either going to property, it's going to go into shares, which is that oil and water that you see most people as investors look at. And look, I mean, the election outcome wasn't necessarily what I expected. Biden, assuming this is the case, which certainly looks to be at the moment, assuming you've got a President-elect Joe Biden, you've also got the possibility of a Republican Senate, so you've got a check and balance. You're a Democratic president, but a Republican Senate. And what that's going to do is create the impasse where, and it's the same issue that Barack Obama had, where it's going to be very, very hard to pass a lot of controversial legislation because you don't have control of that house, and that's actually very good.
It's more certain, right?
Well, in regards to some of the policies put forward in the pre-election campaigns from Joe Biden, that notion of high taxing is unlikely to get through a Republican-controlled House. And this is part of the reason why the markets responded okay to it, because tax rising never good for markets, but the fact that there's a safety catch preventing it in Congress is likely to be the thing that's helped propel markets. And second to that, I've been fairly vocal supporter of Donald Trump, but let's face it, when you've got a market that is buffeted around on a tweet by tweet, you just don't know what you're going to deal with next. It's unprecedented in terms of the volatility.
It's crazy.
And as a trader, in a way, I'm going to be quite relieved to see the end of that. What's happened overnight.
Big deep breath.
For no reason.
No more tweets.
Yeah. So I think, in that respect, a little bit of more normality returning to things, I think is actually quite a positive too. So this is all on the positive side in that ledger. And that affects us here in Australia, obviously, because even though it's the US market, the dog wags the tail and we're effective at the tail in that relationship.
Absolutely. Thanks for that. That's a great insight. Unpacking that, AB, there's a lot of negatives, as we touched on at the start, but also plenty of positives going on. And as we said at the start, totally irrational. So to conclude the broadcast, I want to throw a curveball to you, ask you one final question. What's the fix? What's the answer here moving forward?
Well, I'm trying to break this apart, and the difficulty, and I've been around markets for a long time, and every day and every year, this is the alluring thing of being in this industry as you're beginning to learn, is that every day is a fresh challenge and there's something different. The pieces on the chessboard have moved slightly, sometimes they're in similar places, but they're always different. And in this regard, and this is why it's quite challenging, the negatives more than outweigh the positives by quite some margin. So you've got to ask yourself, how can you have all of this on the negative side of the scale, yet see all this positivity over here? And you wonder, and the talk is wait till JobKeeper is phased out early next year. And you wonder how much of this positive column is being propelled by JobKeeper, in which case, really, it's a smoke and mirrors recovery, because when that cash is pulled out, what's then going to happen?
We can't spend, we can't be confident, surely.
For people in that situation, most definitely not. Personally speaking, I don't agree with JobKeeper at all, but it served its purpose in terms of potentially smoothing out the nature of the pullback and the recession that we were in, and officially we're now not in a recession. I don't think, again, going back to economic figures, the definition of a recession can't be GDP. It's got to be, how do people feel? Have they got jobs? Are they optimistic about the future? That's the difference between a recession and an economic growth, not just a simple GDP figure where if it's down or up, that's the end of your recession, because by no means, for a lot of businesses out there that are flailing around trying to get through, we're not out of recession by a long, long way. And that's the danger of just focusing on a statistic versus anecdotally what's going on. The big focus, as I say, has been a lot on JobKeeper, and also to an extent on JobSeeker, where there's been an overpayment, for want of a better description. I think it's about $25 a week, or $25 a day, I beg your pardon, that goes into the pockets of those people that are on JobSeeker. And you wonder when that starts to normalize and gets reduced to maybe an extra $10 a day, and eventually goes back to the previous level, which is about $40 a day, I think, or $45 a day. People are saying, that's not enough to live on. And my view as someone that's a free marketeer is that to get a balance out in the labour market, you've got to make it very, very uncomfortable to be unemployed.
Sure.
And that's not to say that people are milking this. I know people that are, as you do, as everyone does, right? There are people that are milking, JobKeeper especially. It's hideous the way that's been exploited by people that are unscrupulous, and there are a lot of genuine beneficiaries from it too. But if you remove that safety net, and you get to an equilibrium, it's so painful to be in this situation, you do virtually anything to be over here. Part of that will maybe even out our labour market, and I would hope as once a free market's here that it establishes some form of equilibrium in terms of hourly rate, because our hourly rate at the unskilled level in markets here in Australia is too high.
Sure.
That's brought about by the cost of living, which apparently is only rising by 0.7%. You and I both know it's not. So, see a drop down in that minimum wage level, you get people unemployed back into the workforce. It's easy to employ people. You're also getting government subsidy if they're young enough, and that's potentially our way out. But if this whole positive column here is being propped up on the optimism of a government handout called JobKeeper, it needs to be scrapped, and we need to face our medicine now.
Well, let's hope that's not the case, and let's hope we do recover, because that's what we all want to see, not only surviving, but thriving.
Absolutely.
As cheesy as that sounds. Look, we are at the end of the broadcast now, AB. There's a lot to unpack in there. There's plenty of good points that you've made, a lot of numbers as well, and statistics. What's your final words for the broadcast?
Look, I always try to see things as the most optimistic that they are, and it's about making hay while the sun shines. And I see asset classes, real assets, property, shares doing particularly well. That's where you have to be invested. If you're sitting this out because you're thinking it's going to come crashing down, you're going to miss the biggest game in town until it happens. You've got to be in it. It's as simple as that. I go back to, there's a couple of US economists, one in particular, that's been calling for a crash in the market now for nearly 20 years. And one day he'll be right. But all of his disciples that have followed that have missed out on the boom times while they're waiting for the market to fall. Don't be looking at the negative column too hard. Hook your colours onto the positive. The train's going, if not gone, get on it, make some money for yourself. But be aware of risk management so that you know when things cut up and they start to get a little bit rough, you're not going down with the ship. You can get out and position yourself accordingly. And that requires, of course, some level of education. But positive side at the moment is well outweighing the negative side. Let's hope it stays that way. But let's hope it's positive for real, organic, inbuilt, sustainable reasons, rather than simply that defibrillator of the government subsidy pumping it up. I really hope it's not that.
Sure. Great advice, great points. Thanks very much, AB. You heard it here first. Cheers.
Always a pleasure, Mitch. Thanks very much. Well, there you have it, guys. Make sure you subscribe, put some notes and comments and feedback in the bottom, and hit the notifications button so you can be kept up to speed with when we're bringing new information to you.